Welcome to our class today, and I want us to be able to discuss about the income statement. And the income statement is one of the final accounts usually prepared in tandem with International Accounting Standard number 1. So the International Accounting Standard number 1 requires accountants to prepare the income statement, which is going to show the performance of the business, and also the statement of financial position, which is going to show us the financial status of a company. So the income statement is basically prepared to be able to ascertain the performance. How is the company performing, or how is the enterprise performing in terms of profit that is making, or any kind of particular losses. So if a company is or a sole trader is making a profit, then it is performing better. If it is making losses, then it's not performing well. So now, before we do that kind of particular question that is here, I want us to be able to have an understanding about the format of that kind of particular income statement. How can we prepare it? Before we go to the question, let us be able to have a good understanding of the format of that kind of particular income statement. So the income statement is always going to be given a title. We must have a title for that income statement. For example, we can have ABC. We can have a title like ABC Enterprises. We can have that title, ABC Enterprises. Income statement for the year ended. For the year ended, maybe 31st December 2020. So you can have that ABC Limited, and that's actually the title there. And that's what we usually start with. For example, you can be able to see in this kind of particular question that I'm having, is all it talks about is the enterprises. So meaning that our title, when we are going to do this question, is going to be Ezra Enterprises income statement for the year ended, maybe 31st December 2020 there. So that's what we are required to be able to do. Under the title, we must have that kind of particular title. And apart from the title, the next thing that we need to be able to have an understanding, what should we be able to start with? So in the question, we always start with the sales. When preparing the income statement, if they have given you sales, that's where you start from. So you start with the sales, but before I start with those sales, I need to have 3 currency signs. So I need to have Kenyan shillings here, Kenyan shillings there, and then Kenyan shillings to the other kind of particular part. And then I start with the sales. So I'm going to have my sales here. And the sales are going to be in the last currency sign. So I should put my sales in the last currency sign there. And the sales have only one adjustment. And that adjustment is what we call the sales returns. The other name of sales returns is actually what we call returns inwards. So if you see returns inwards and the sales returns, they basically mean the same. So if we have the sales returns, we say we less the sales returns, which is the same as the returns inwards. So the sales returns is the same as returns inward, and it is the only adjustment that is going to be under the sales here, that is going to be made under the sales. And then, so if you take your total sales, you minus the sales returns or returns inwards, you are going to have what we call the net sales. You'll be able to have the net sales here. So you'll be able to have that net sales. So sales less sales returns, you are going to have the net sales. And that is the only adjustment that is going to be adjusted under the sales figure. So sometimes you can just have sales only without having the sales returns. So what it basically means, if you have the sales only, that is going to be your net sales, because you are not having that kind of particular returns inwards or the sales returns. So you check that question, sometimes they can give you the sales returns or they may not give you. So if they have not given you, then the sales figure that you are going to be given in the question, it is going to be your final, which is going to be the net sales the way it is, the one that you have actually been given. So the next thing that you are going to have, which now you are going to be keen of, is actually the adjustment whereby you are going to less the cost of sales. So lessing the cost of sales is whereby you need to be vigilant and careful about it, because that's where most of the students are going to find a problem. Sales, they do not have, you will not have any problem about it because it has only one adjustment. But when you are going to say less cost of sales, less cost of sales, that's where now you should be careful with. In fact, if you can be able to understand the cost of sales, then the income statement, you will not have a problem with it. It's all about understanding how you deal with this kind of particular cost of sales. So how do we find the cost of sales? So when we are saying we rest the cost of sales, this is the formula. Let me just give you a formula of finding the cost of sales somewhere so that you can understand. And then of course I'm going to move it here. So the cost of sales is always opening inventory or stock plus net purchases minus the closing inventory. Remember, closing inventory is the same as closing stock. Opening inventory is the same as opening stock. So this is how we find the cost of sales. We are going to take the opening inventory or the opening stock. We add net purchases, not only purchases. There is a difference between just adding purchases and also net purchases. So in this case, we are going to add net purchases, meaning that we must ensure that the purchases that we are going to add to the opening inventory is net purchases. So we are going to make some adjustments on purchases until we arrive at a figure known as net purchases, and then of course we are going to less the closing inventory, and after lessing the closing inventory, then of course we can be able to get those kind of particular cost of sales. So this is the formula of getting the cost of sales, and once you maybe you can write it somewhere, because I'm going to erase it from here so that we continue with the format. So I'm going to apply that kind of particular formula that I've given you of getting those kind of particular cost of sales. So for us to arrive at the cost of sales using this kind of particular format, we are going to say we are going to have opening inventory. Sometimes in the question they will give you opening stock, and most of the time in the question, remember we are going to prepare the final accounts from the trial balance. So like this one, what you see here is a trial balance extract. I'm calling it a trial balance extract because you cannot be able to see the debit side and also the credit side. So when you do not have that debit side and the credit side, that trial balance there is just an extract. So this is an extract of the trial balance. So opening inventory, we have said that you are going to know it from the trial balance extract, whereby they are not going to say that that is opening inventory. You will just use the dates. Like for example, if you're going to be able to see from this trial balance extract, the opening inventory, the date is 1st January 2020. That's how you know that is opening inventory. The closing inventory, sometimes the closing inventory, we always find it in the additional information. But in this case again, I can be able to see the closing inventory was being given in that trial balance extract. And again, we have said that the dates will be able to help us. So if you can be able to check this kind of particular dates here, you see inventory 31st December. So when you see 31st December at the end of that year, then that is closing inventory. But when you see 1st January 2020, then that is opening inventory. So that's how you can be able to know the difference between the closing inventory using those kind of particular dates, because they cannot say that this was the closing or rather this was the opening. So you are going to use those kind of particular dates in terms of knowing whether that's an opening inventory or a closing inventory. And the inventory, I've said, is actually stock. But nowadays, most of the questions that you are going to have, they will have that inventory. They are trying not to use the word stock. They are actually, accounting is evolving. So they are using inventory most of the time. So that's what you'll be having there. So the opening inventory is always on the second current sign. So that opening inventory, like now this one, when we are going to do the question, this opening inventory of 108,000 is going to be under the second currency sign there. So this is the first current sign, which is Kenyan shillings, second currency sign, and also the third currency sign there. So the opening inventory is always captured in that second current sign, and then we add purchases. And in this case, it's just the purchases. I've not said net purchases. We are just adding purchases, and then we are going to make an adjustment on that kind of purchases until we arrive at the net purchases. So the purchases figure that you are going to be given is going to be in the first currency sign. So in the first Kenyan shilling there, that's why you put your purchases. And we are putting it there because we want to be able to make adjustments on those kind of purchases until we arrive at the net purchases. So what can we do there? So after adding the purchases figure, so for example, you can be able to see purchases was 400,000. So that 400,000 is what you are going to have it here. So let us make that kind of particular adjustment on purchases until we arrive at our net purchases. So we are going to add the carriage inwards on the purchases. So we add carriage inwards. So the carriage inwards will be added on the purchases. So carriage inward is that transportation cost of transporting goods from the point of purchase to your premises. For example, you have a business and you go to to your supplier and you buy some goods, maybe 100,000 that you can't carry yourself. So you hire a vehicle and you pay the vehicle for those kind of particular services, transportation services of transporting the goods from the point of purchases, from the point of purchase to where you are going to sell those kind of particular commodities. So that kind of particular transportation cost that you have paid the owner of that vehicle for transporting your commodities is what we call carriage inwards. It's part of the purchases cost. So that's why we are going, if you are going to have the carriage inward, then it's going to be added to the purchases. So again, most of the students are going to confuse between carriage inwards and the returns inwards. So you can be able to see returns inwards and the sales returns. So don't confuse. So returns inwards is, sometimes you can make sales on credit, and when you have made sales of 100,000 on credit, whereby they do not give you cash, and then your credit customers decide to return those commodities, what may be 20,000 because it has expired. So those kind of particular returns that is going to be made by your customers is what we call the returns inwards. The one that you sold and then they returned the goods back, maybe because maybe you sold to them expired goods or the goods that were not of the right quality or the right quantity. So if your customers are going to return the goods to you, then that one becomes the returns inward or the sales returns. So what you had sold, now they are actually returning to the business. So don't confuse between carriage inwards and returns inwards. So returns inwards is the same as sales returns, and it's going to be under the adjustment of the sales. But the carriage inwards is going to be part of the purchases, because what you purchased, you transported it to your business, and it's going to be captured there. So that carriage inwards, if you have been given the carriage inward in the question, is going to be added with that kind of particular purchases. And then we are going to less drawings on purchases. So lessing, I'm just going to put it in a bracket there. So drawings on purchases, sometimes what you have purchased, you may decide to consume it, or you may decide to use it. Maybe you are into business of selling some pieces of nice clothes, and then when you are actually, you have purchased those kind of particular clothes, you decide to take maybe the one that you see you desire. Maybe you are going to have that kind of particular wood cloth that you see this is the one that I should be having or I should be wearing, and then you take it, you say that this one I'm not going to sell it. So that's what you call drawings. You decide to consume what you are actually going to sell. So that one is not going to be part of the purchases, so you are going to subtract it. Those kind of particular drawings on purchases. Again, another kind of example is whereby you are into the business of selling loaves of bread. You purchase 50 loaves of bread to sell during the day, and then you take 5 of them to consume with your family. So you see now, the loaves of bread that are going to remain are actually 45. So you must be able to remove those kind of particular, what you have consumed, which is going to be part of the drawings. So drawings on purchases, they must be subtracted. If you have taken some drawings from what you purchased, you have consumed some of your purchases, then you must subtract it so that you get that net purchases. Remember, the idea is to get the net purchases. We want to have the actual purchases. So the one that we took from the business for our own use must be subtracted from the purchases, so that we arrive at the actual purchases for that kind of particular financial year. So the drawings on purchases must be subtracted. And then again, we are going to less purchases returns. So purchases returns is what we call returns outwards. And again, that one must be subtracted. So if you have purchases returns, is what again we call the returns outwards, and the purchases returns are those kind of particular commodities. You went to your supplier, you purchased the goods, and you discovered that some of the goods that you have purchased, maybe they were not of the right quality or the right quantity, or some had also expired. So you decided to return them to your supplier. So that's what we call the purchases returns. So what you returned to your supplier, or the returns outwards. And now that's where it comes from. Now you have those kind of particular goods and you are returning outside the business. That's where the name comes, the returns outward. That's where it emanates from. So you purchased, but now you want to return them because those kind of particular goods, maybe they had expired. So those purchases returns are then, they must be subtracted from the actual purchases, so that we can be able to arrive at the net purchases. So the answer that you are going to get here, so for example, you can have maybe purchases was 50, and the carriage inwards was also 50, and maybe this one was 10. That's the drawings on purchases, and also purchases returns also was 10. So now you are going to add purchases plus carriage inwards. So that is going to be 50 plus 50, that's going to be 100. And then of course you are going to less, because they are saying you less drawings on purchases. So and the drawings on purchases that you have been given here is 10. So it's going to be that 100 minus 10, which will be 90. And again that 90 minus the purchases returns, or returns outwards, which again we have said is 10, which is 80. So that 80 is what you transfer to the second current sign. So that now we are going to have that opening inventory which was in the second current sign plus these net purchases. Now this is what we call the net purchases. Now you have actually made that adjustment. So when you take purchases, you add carriage inwards, you less drawings on purchases, you less again purchases returns. The answer you get here, which I've said is 80, because I've assumed this was 50 plus 50 minus 10 here. The answer you get here, which is 80, is what we call the net purchases. And that net purchases is going to be added with the opening inventory. So the net purchases is going to be added with that opening inventory, which was already in the second current sign. And so now you are going to add it. So you will get an answer there. So you are going to add the opening inventory plus this net purchases, and you have an answer down here. And that answer, we call it the cost of goods available for sale. So that answer is what we call the cost of goods available for sale. So that cost of goods available for sale is actually the opening inventory plus net purchases. You get the cost of goods available for sale. So after getting the cost of goods available for sale, then we have to subtract. We are actually going to be able to subtract the closing inventory. So we are going to say less a closing inventory. And the closing inventory, again, I've said is the same as the closing stock. So you are going to less it here. And because you are lessing, it should be inside that bracket. And what you are lessing there, you are going to less it from the cost of goods available for sale. So if you less the closing inventory from the cost of goods available for sale, and remember the closing inventory is that inventory at the end of the year, which is 31st December 2020. This kind of particular inventory is what you are going to be able to less from here. So when you are going to less the closing inventory from the cost of goods available for sale, then at the end of the day now you are going to have cost of sales. So the answer you get here, you are not trying to put it below here again, but you transfer it to the third current sign so that it will be subtracted from the net sales. So, the answer that is here is actually the cost of goods available for sale. So, cost of goods available for sale minus the closing inventory, you are going to have the cost of sales. So, this is the cost of sales that is going to be here. So, the answer that you are going to transfer to the third current sign is the cost of sales. So, you take the cost of goods available for sale minus closing inventory, you have the cost of sales, and it's inside a bracket because we say the less cost of sales, and because now this is the cost of sales, that is why it is inside that kind of particular bracket. So if you take the net sales minus the cost of sales, then you are going to have, the answer that you are going to have here is going to be gross profit stroke gross. So sometimes it can be gross profit, sometimes it can be a loss. And back in the days, when we were in high school, we used to prepare the trading account. So the trading account is up to the gross profit or the gross loss. So maybe if you find a question whereby you are required to prepare the trading account only, the trading account goes to the gross profit stroke gross loss. Especially for those people taking bookkeeping and accounts, if you want to prepare the trading account is going to be up to here. Remember, the other name of the income statement is the trading profit and loss account. So it combines the trading part and also the profit part, but nowadays we call it the income statement. We are going to continue by adding other income. So we are going to add other incomes. So you'll be able to add other incomes. And some of the other incomes that we may have is like discounts received. Discounts received. So we are going to have those kind of particular discounts received. It will be added here to the gross profit. Again, we can have rental income. So we have rental income. It can also be added here. So we can have several, even a decrease in provision. All decreases in provision, they are going to be incomes. But now, let us say that these are the ones that we have. We can also have commission received. They will be added here. So I'm not going to list all of them because of the space here. So if you have other incomes, discount received is always an income, and it will be added to the gross profit. That's what you need to be able to know. But the discount allowed is an expense. It's going to be under the category of expenses. So that one again, you need to be able to capture that in details. So when you add the other incomes here, what we are going to arrive at is what we call the total income. The total income. So the answer that we are going to get here is the total income. And now you go to the other kind of particular expenses. The next thing is going to less all expenses. So I'm going to say less expenses. And we are going to less all the expenses. Some of the expenses, because of the space, I'm going to maybe have 2 or 3. Some of the expenses that we are going to see that are appearing in the questions are like the bad debts. So if you have bad debts is an expense, and all expenses are going to be listed in the second current sign. So if you have bad debts will be listed there. Carriage outward. Carriage inward is always under the adjustment on the purchases, but carriage outward is always under the expenses category. So if we are going to have carriage outwards, that carriage outwards will be here. It's going to be part of that one. So we can have several expenses like rent paid. So we are going to have the rent that was paid. Then of course we are also going to be able to add it there. We are going to have salaries and wages. So we are going to have the salaries and wages. Salaries and wages is also part of the expenses. So that kind of particular salaries and wages is going to be captured here. So we can have several expenses. I've said it can be several. We are going to have several, like also depreciation. When we are going to calculate depreciation, like for example, you see here we have the provision for depreciation on motor vehicle is provided at 15% per annum on the cost. That depreciation that we are going to calculate is going to be part of the expenses. So we are going to write the depreciation, and then of course we write it there. So let us assume that in this case we have those ones. So you are going to add all expenses, and you transfer it to the third current sign. So all expenses there, you transfer it to the third current sign there, and you are going to less them because we said less expenses. So the answer that you get there, the total expenses that you have added under the second column, the second current sign, all the expenses, you transfer there, and you less it from either the gross profit or the gross loss. And the answer that we will get down here is what we call the net profit stroke loss. So if it's going to be a negative, it will be a loss. If it's going to be a positive, it will be a profit. So that is an income statement. That's how we prepare an income statement. And now I want us to be able to do it practically from the given question that you can be able to see on this kind of particular whiteboard. So you want to be able to prepare that income statement using this kind of particular format. So that's how you prepare it. You prepare that income statement. And now I want us to prepare it from the question. That's a neck question. So I want us to be able to use it in terms of preparing that kind of particular question here, which is the income statement. So now let us be able to prepare it. So we have the question, and the question, yeah, they are saying that the following information it relates to Ezra Enterprises, and that is Ezra Enterprises for the year ended 31st December 2020. So it's all about the Ezra Enterprises, and the information is on that 1st December 2020. And the key thing that I want you to be able to have is this information. So this we have been given the inventory as at 1st January 2020, and that date I've said that we want to analyze that is opening inventory because of the date. And then you have been given purchases, you know where purchases you are going to have it. You have been given the motor vehicles. A motor vehicle, that's an asset. And when it is there, whereby we are going to prepare the income statement, most of the time those non-current assets, they go to the statement of financial position, which is the balance sheet. So if you see an asset in the extract and you are only required to prepare an income statement, that non-current asset is there so that you calculate the depreciation on it. And remember, depreciation is an expense. So this one, this figure, the 2 million, we are going to calculate the depreciation, and you can be able to see they are saying that provision for depreciation for motor vehicle is provided at 15% per annum on cost. So it's going to be 15% of 100 times that 2 million. The answer that we get there, we take it to the depreciation under the expenses, because we have said the depreciation is an expense. So the other remaining part, the 2 million is just for calculating depreciation. So we are not going to put it else, somewhere else again, apart from maybe if we are to prepare the balance sheet, and in which case, in this case, we are not preparing the balance sheet or the statement of financial position. So we have the sales, and you can be able to remember where sales we should be able to put it. We have the returns outwards, and the returns outwards are actually purchases, returns. And then you can be able to see carriage inwards, and then you remember what we said about carriage inwards. And then we have carriage outward. So carriage inward is under the cost of sales. Carriage outward is going to be under the expenses. And then you can be able to see that we have salaries and wages. And that salaries and wages is also going to be part of the expenses. And then you can be able to see discount allowed here. And the discount allowed is also an expense. But discount received, like the one that you see here, discount received is an income. So it's going to be added to the gross profit. Bad debts, those are expenses, whereby they are going to be under the category of expenses in the income statement. And then, of course, you can be able to see we have inventory at 31st December 2020. So this inventory, this kind of particular inventory, is what we call the closing inventory, which is also going to be part of the adjustments of actually the cost of sales. And then, of course, we have the additional information, and that's why we always start from. So when you have a question of the income statement or the statement of financial position, always start from the additional information, make the necessary adjustments before starting doing the question. So the additional information there, it says that provision for depreciation on motor vehicle is provided. So provision for depreciation on motor vehicle is provided at 15% per annum on the cost. So when they use that word, that 15% per annum on the cost, what it basically means that we are going to use a straight line method of calculating depreciation. When you see the word on cost, so it's going to be the straight line method of calculating depreciation. But if it's going to be on net book value, Then of course we are going to use the reducing balance method of calculating depreciation. So reducing balance method, they want to say that the provision for depreciation on the motor vehicle is provided at 15% on net book value. So if they use the word net book value, and remember net book value, for us to have the net book value is equals to cost minus accumulated depreciation. So that's how you get the net book value. But in this case, we are not interested with the reducing balance method because we are not trying to, the depreciation here is on cost, it's not on the on net book value. So maybe the other kind of particular subsequent videos, I can be able to provide you a question that has the net book value. So if we are going to calculate depreciation on the net book value, then we must first of all take the cost that you have been given, and of course they will give you accumulated depreciation. You less it before you calculate that kind of particular depreciation. So what I basically mean, for example, in this one, the cost is 2 million. So if they wanted us to calculate the depreciation on reducing balance method, they could have given us an information here that the accumulated depreciation for that motor vehicle was maybe 200,000. So we are going to minus 200,000, and then of course we are going to have 1.8 million, 1,800,000, and then now you will be able to take 15% of 100 times 1.8 million. So you take 15% of 100 times 1.8 million. So when you do that now, you have calculated depreciation using the reducing balance method, because the depreciation that you have calculated is on the net book value after subtracting the accumulated depreciation. So net book value, they must give you that accumulated depreciation always. But on straight line method, you just go direct. So if I can calculate 15 of 100 times 2 million, the answer I get there is going to be the answer of the straight line method of depreciation. On the net book value or on the reducing balance method, you must be able to less that accumulated depreciation, and they have to give you accumulated depreciation for the motor vehicle so that you arrive at the net book value, and then after arriving at the net book value is when now you use that percentage in terms of calculating depreciation. So in this case, what we do, we just go direct because depreciation is on straight line method. And that is one of the methods that is commonly tested. So what you do, you are going to write workings, and those workings have marks. Those in your exams, so you are going to take 15%. They are saying that, so your workings, you say depreciation for motor vehicle, which is actually 15% of 100 multiplied by 2 million. So you take that 15% of 100 and then you multiply by 2 million. So let me use my calculator. So 15% of 100 times 2 million, that is going to give me 300,000. So depreciation that I'm going to take as my expense in the income statement will be that 300,000. So it will be 300,000, and that is depreciation. And of course you get a mark. So that working, when you are doing your exam, you ensure that you don't do it maybe at the back of that booklet. You do it at the beginning, so before you start the income statement, because in accounting we mark those kind of particular workings. We must mark them. So the 300,000 is a depreciation, and after doing that, you have your mark there. Then the next thing now, after it was done an adjustment, of course, you have several. You can have prepayments and accruals, and this question was not having that one. So that is, we have known that it was 300,000. So remember, when you are going to prepare the income statement, under the expenses category, we will have that 300,000. So after doing that, now what we do, we can be able to start the question itself. And we always start with the title because it is all about Ezra Enterprises. I'm going to say here, so I'll have my title as Ezra Enterprises. So I'll have my title as Ezra Enterprises, so I can be able to say that you can't see it there. So I'll have it here, Ezra Enterprises. So Ezra Enterprises income statement. So Ezra Enterprises income statement for the year ended. For the year ended 31st December. So they have given us the year. It was 31st December 2020. 31st December 2020. So that's how we are going to start it, and we are going to have the three currency signs, Kenyan shillings here, Kenyan shillings there, and the last three Kenyan shillings there. So we have those three currency signs, and we always start from the sales. So we need to be able to start from the sales, and we are going to start with that sales figure. So we start with the sales here. And if you can be able to see the sales figure that you have been given in our question is 1,900,000. So that's what you do. And that sales is always under the last currency sign as 1,900,000. So that 1,900,000 will be there. And then of course the next thing that we will be able to do is to be able to less the sales returns or returns inwards. If we have the returns inwards, then it's going to be captured there. So if you can be able to see my question, we have inventory, motor vehicle there, the sales. So we have returns inwards, returns outwards. So meaning that we do not have that kind of particular returns inwards or the sales returns. There's not appearing the information. So if it's not there in that information, now what we do, this answer here is actually going to be our net sales automatically because we do not have that returns inwards figure or the sales returns. So we just leave it the way it is, and we make an assumption that is always our net sales. And then of course we go direct to the cost of sales, so we are going to say less cost of sales. So we less the cost of sales. And I told you that this is whereby you need to be extra keen and careful because that's where you need to be able to understand, and the moment you understand the cost of sales, the income statement becomes very simple to be able to do it. So we less the cost of sales, and at the cost of sales there, we start with, remember, cost of sales is always opening inventory plus net purchases minus the closing inventory. So in this case, we start with the opening inventory. The opening inventory. And the opening inventory here, the opening inventory that we have here, you can be able to see from the dates, is 108,000. And that 108,000, 108,000, 108,000 is always going to be under the second current sign. So we put it under this second current sign, the 108,000. And the next thing that we're going to be able to do is to add purchases. So we add purchases. And in this case, you're going to be able to see our purchases. Our purchases figure is 400,000. So that 400,000 is always under the first current sign. So it will be under the first current sign. So you put it there, that purchases. And of course, we want to make the adjustment on purchases until we arrive at the net purchases. So on this kind of purchases that we have, we are going to add carriage inwards. And sometimes, remember, carriage inwards may not be there. So the information that you don't have, you are not trying to put it here. Like now, you can be able to see we are not having the sales returns, but we left it the way it was there. So now we add carriage inwards, and the carriage inwards, you can be able to see this carriage inwards here is 40,000. So we'll be able to add 40,000 here on our purchases. And then the next thing that we need to be able to subtract is the purchases, I mean the drawings on purchases. If we have drawings on purchases, and you can be able to see from the information, we do not have drawings on purchases. And remember, it must be drawings on purchases. Otherwise, if you find an information which is only drawings not going to be captured here. Drawings usually goes to the statement of financial position, under capital. It's trying to make an adjustment on capital. So in the equation, they must state clearly that this was drawings on purchases, not another kind of particular drawings. So that, because we don't have it, we are not trying to add anything there. And then of course, we need to be able to subtract what we call the returns outwards, or what we call the purchases returns. And you can be able to see that we have that returns outwards here. So we are going to less returns outwards. And that returns outwards is the same as purchases returns. And the amount is 60,000. So you are going to write your 60,000. And that 60,000 should be enclosed inside that bracket. So you capture it that way. Then the next thing that now we should be able to do is to add the 400,000 plus 40,000 minus 60,000. And then we are going to have an answer. So what we do, that's what we are going to do there. So that is 440,000. And then you get 60,000. And then of course, you are going to have 380,000. So that 380,000 is trying to be transferred here. 380,000, which is actually now the net purchases. Now that's what we call the net purchases. So net purchases is going to be added with that opening inventory. So we are going to take 380,000 plus that 180,000 there, plus 108,000. Then we are going to have 488,000. So the 488,000 there is what we call a cost of goods available for sale. Cost of goods available for sale. That's what that's how we call it. So opening inventory plus the net purchases, you get the cost of goods available for sale, which is 488,000. And then of course the next thing that now we do is to less. We are going to less closing inventory. We less the closing inventory, and the closing inventory here, if you can be able to see it, is this inventory on that 1st December 2020, which is 72,000. So you are going to take 72,000 here, you less it. You less that kind of particular closing inventory, which is actually 72,000. So if I take 488 minus 72,000, then I'm going to have 416,000, which I will transfer direct here, 416,000. And this 416,000 is what we call the cost of sales. Remember, from the beginning you said less cost of sales. So that's why this 416 is going to be inside a bracket. So you are going to take your sales figure, which is the net sales here, because these are our net sales, in that now we were not having the returns inwards. So now you are going to take 1,900,000. then you subtract the 416,000. Then of course you are going to have 1,484,000. 1,484,000, and that 1,484,000 is what we call the gross profit. So that's how we arrive at the gross profit. And now the other part is going to be easy because we are going to add other incomes if you have them. So sometimes you may not have them, and if you do not have them, you don't make this adjustment of adding other incomes. But now we have it because I can be able to see the discounts received somewhere. So yes, I can be able to see that discounts received. So the discount received that you can be able to see here is always an income, and it must be added to the gross profit. And the discount received is 52,000. So we are going to add this 52,000 here. So we do not have another income, so we add that discount received. So I'm going to take 1,044,000 plus 52,000, and I'm going to have 1,536,000. 1,536,000, and that answer I will call it total income. So this is my total income, which is 1,536,000. And then of course I go to the easiest part, which is going to be less expenses. So we are going to be able to less expenses, and all expenses they are going to be captured in the second current sign. So in this case, one of the expenses that I'm going to have, I can be able to see I have that adjustment. Let me start with the one that we did, which was the adjustment of depreciation. So I can say depreciation of motor vehicle. So you can be able to remember that depreciation was 300,000. So it will be captured here, which was 15%. It was 15% of actually that 2 million. And we arrived at 300,000. So depreciation on the motor vehicle will be that 300,000, and we are going to have discounts allowed. Discounts allowed, so it's part of an expense. Received is an income, but the discount allowed is an expense. That's why discount allowed being an expense, it usually appears on the debit side of the trial balance, but the discount received is always on the credit side of the trial balance. So discount allowed that we have here is 22,000. So we are going to have that discount allowed of 22,000 there. And then of course we have bad debts. So these bad debts, and the bad debts you can be able to see is 33,000. So you'll be able to capture it there, that 33,000. And then we can be able to see that we have salaries and wages. So these salaries and wages. So the salaries and wages here is going to be, so it will be able to, so let me see the depreciation there, discount allowed. Discount allowed was 22. So salaries and wages is 220. Salaries and wages is 220,000. It will be captured there. And we have the carriage outwards. Carriage outwards is part of the expenses. So carriage outwards. So carriage outwards, the meaning of it is now when you have a business and you are offering after-sale services of transporting the commodities that you are actually selling to your customers. You offer free transport. And that cost that you incur in transporting those commodities is what we call carriage outwards. So carriage outwards is actually, and be able to see, is 40,000. captured here as 40,000, and then I can be able to see that we have actually captured everything under the expenses. So what now we are going to do is to add. We are going to add all expenses. I start with 300,000, and then I will add the 22,000 there, and then I add 33,000, and then I add 220,000, and then 40,000. And the answer that I have is 615,000, and that's the total expenses. So you transfer it to the third current sign. That's 615. You transfer it here so that you subtract it from the total income. And if I take now 1,536,000, so this 1,536,000 here minus 615,000, so the answer that I get is 9. So I'm going to have 921,000, and it's a positive answer. So because it's a positive answer, that is a net profit. So that's how you prepare the income statement, and that is the format of preparing that kind of particular income statement. So that's how we prepare it, the format and the question, so that question can be able to help you in terms of revising for your exams. So thank you, and then of course we are going to have other kind of particular videos more about now the statement of financial position. We will be able to prepare one, and also we are going to be able to prepare some control accounts. So thank you until we meet again.